Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I've got Stephen Little, Zero Limit Ventures on the show with me today. Steve, welcome to the show.
Thank you again.
All right, I'm glad you're here. All right, valuation and prepping for a funding round. Talk to us about that.
Well, I mean, the obvious concern here is when you're going out to raise capital, you have lots of different vehicles for raising capital. If you're going to sell equity to raise that capital, you're basically selling some portion of your business. You want to make sure that the value of that business is set such that you don't have to give away the whole farm to get the money. Right? So having a clear understanding of what your business is actually worth on a fair market basis is important. Now, when you do valuations, there are a lot of different reasons to do evaluations. There's cap raises, there's acquisition, there's, divorce litigation, there's, other types of conflict litigation. So there's lots of reasons to do a valuation. Mm-hmm. And each one of those valuations is going to be done in a manner that's cognizant of the reason. So, for instance, if I'm a CEO of a company, having a valuation done because I want to raise capital, I want that valuation to be relatively high so that I don't have to sell too much of my company to get a lot of capital, right? If I have a high share price, then I can get a lot of money for each of the shares I sell. I have to sell less shares, right? Mm. So, obviously I can't manipulate that, so to speak, but I can understand what the valuation equation looks like, and I can implement a valuation growth strategy or valuation retention strategy if necessary so that I can garner the maximum value for each share that I sell in that cap raise.
How would that differ from, say, a merger?
Well, it doesn't differ a lot because the similarities are, and basically a cap raise is just it's like a partial acquisition, so they're very much the same. The distinction is, what happens in the end, and there are a lot more options available to you when you're doing a cap raise than if you're just selling the company outright. Now, one of the interesting things that I generally tell my clients to do is, if they're in a merger and acquisition scenario, so the owners either want to get out or they want to bring in another management team or
or a new product
right? Then you would think that by definition you're moving into a growth mode, right? Otherwise, what would the incentive be to do that, right?
Yeah.
And so you want to maintain or retain as much equity as possible because the growth value of that equity should be accelerated by the result of the merger or the acquisition. So if it's an outright sale and we know the buyer is a growth-oriented buyer, then I'm going to recommend to the seller, look, keep 10 to 15% in the company. So, we'll negotiate a deal. Maybe it's a $10 million deal. You take $8.5 million in cash, leave, $1.5 in, right? And that 1.5, 5 years from now, is going to be worth another 8.5, right? So it could be as much or even more than the first return that you generated when it turns again, right? So, it's a way for everyone to win because the buyer gets to have you around and gets to, you have a vested interest in helping the transition be smooth and so on and so forth. And the other end is that when it comes time for the next turn, you're in line, just like all the other investors in the business, to be a winner.
Got it. Thanks, Steve.
You bet.
All right, you've been watching CEO Money with Michael Yorba. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.